All right. So before we start this, I just want to thank Gaurav Singh, our sponsor at Morgan Stanley India, for mentoring us on this project, and it was very helpful. So, past performance is not indicative of future results. Beneath every beautiful green line, you will see these not so beautiful words. But luckily, investors always protect themselves, right? They learn from their mistakes. They don't get overcome by greed. They make smart, rational choices with the humility that they might be wrong. No, they don't. But can you blame them? Because if past performance is not indicative of future results, what is? Hope? Well, let's entertain the perspective that past performance is always indicative of future results with the idea of momentum. Momentum is the idea that the things that have been happening are going to keep happening. Past trends continue, drawdowns are short, stocks keep going up. It's a comforting story. But momentum has limits. Let's say you had a stock that went up 30% last year. Strong contender for momentum. Maybe you'd buy it. Maybe you'd put it in your momentum portfolio. And maybe you'd get good returns because you could probably make the case that with a return like that last year, next month it could go up again. But let's say you had a stock that went up 1,000% yesterday. And would you buy it? Maybe you would. But on average, I'd sell it to you because on average, it's going to go wrong for you. I'll address on average in a minute, but first I want to discuss the concept of reversal. Reversal is the idea that sharp, aggressive trends tend to be punished. Now, with the help of my graduate degree, I've been able to tell you that sometimes things change and sometimes things stay the same. But what's important is I can tell you when. The way I can tell you when is by spending the last 3 months building a completely customizable auto-rebalancing backtester that can account for any ranking criterion, any portfolio rebalancing frequency, and any weighting structure that I want. This is the momentum backtester. So instead of just asking, show me a momentum portfolio, the quants in the audience will want to hear, give me a lagged momentum ranked, equally weighted portfolio with 1 month rebalancing, no outlier elimination, 0.02% rebalancing costs, and 20 stocks selected. Now, in English, I'm asking to search the entire Russell 3000 and rank by lagged momentum. Buy the top 20 stocks, rebalance after 1 month, and repeat the process. Now, lagged momentum is the amount a stock has returned over 1 year, skip the previous month. And the reason you skip the previous month is to avoid reversal problems, which we'll talk about. So, how do we do? Well, we do not too bad for a baseline. The line's going up for a start. After about 14 years, you get around 250% return, which is okay. But the huge problem, as you can see, is we get a gigantic drawdown during COVID that never recovers. And you see an even bigger problem when you add the S&P. This strategy is a terrible strategy compared to the S&P 500. It's more volatile, it performs worse, but it moves in the right direction. So, while we've established the signal is weak, we've established that the signal exists. Let's move on to reversal. For reversal, this time show me a 3-day momentum ranked, equally weighted portfolio with 3-day rebalancing, no outlier elimination, 0.02% rebalancing costs, 20 selected stocks, but this time I want to add 4% margin interest because we'll be going short. This portfolio seems to do a bit better. Let's add our momentum portfolio for scale. And let's make the scale a little clearer with the S&P. So now you can see that this portfolio returns a lot better, 1,000% in fact. But the volatility looks a lot scarier than before. In fact, you get around a 65% drawdown in the middle, which is just unacceptable. So ideally, we'd have a portfolio with the crazy returns of the reversal without the crazy drawdowns. Now, you're always going to have to accept some sort of trade-off, but there's a clue for how to address that in the shapes of these two graphs. If you take a look at the biggest peak for momentum, it corresponds to a pretty large valley for reversal. And that corresponds to about the COVID crash. As it turns out, the reversal portfolio, the COVID recovery. The reversal portfolio loves bad times. If you look at where tariffs come into the graph, there's a huge spike. There's a huge spike again at the COVID crash. And momentum moves in almost a completely opposite direction. This suggests an idea that I've already alluded to, but I'll say explicitly. The momentum and reversal are in some way opposites. Let's see if we can let these two portfolios protect each other. And let's get rid of some lines for clarity. So this is our even-weighted long-short portfolio for momentum and reversal. It performs about the same as the S&P, but unfortunately the volatility is still pretty high. So why would you want something like this? Well, if you take a look at moments in the graph where the S&P experiences a downturn, you'll see that the beta of our long-short portfolio gets jacked up in the negatives like crazy. So this portfolio could possibly add some downside protection to someone that is hoping to expose himself to a market correction. But what else can we do? Well, we can try removing outliers. We can try changing our long-short balance. Maybe we don't want 50-50. We can try weighting by variance. Maybe we can give more or less priority to stocks with higher or lower variance to try to change our returns or our drawdowns. And we could change our portfolio sizing from maybe 20 to 50 to 100 to see how it performs. But as it turns out, we did try all these things. And when we tried them, we found that they all had the same sort of effect, which is that it changes our balance of risk and return. This is a lot to change at once manually, so the next logical step is optimization. So I'll let Casey talk about that.
Kobe is exactly correct. So we have a decent momentum portfolio with even weighting, but there must be some way to squeeze more value out of this portfolio. At Lehigh, we take a class called Financial Optimization, and we learn about the magic of linear programming optimization. And it seems easy, and we should be able to use it. And I'm sure everyone in here has their perfect, hypothesis for what makes a good portfolio optimization. But let's start with just the basics. Maybe your first thought if you're going to optimize a portfolio. Let's optimize returns. I like returns. That's what we're going after. I just want better returns. So let's see how we do. Wow, that is pretty amazing, actually. It looks pretty great. And I love 24,000% returns. Let's see what our portfolio is. It is just NVIDIA. Our optimizer gave us just a pure 100% NVIDIA portfolio. I love NVIDIA, but that is maybe not a great portfolio theory practice. So, we have a couple more tricks up our sleeve. Maybe I want to maximize how much weight we can shift when we're optimizing from our even weight portfolio. We get a nice frontier that looks pretty okay. And let's choose a pretty reasonable value. I'm not feeling too greedy. We can change up to 25% of our portfolio weighting from the even weighting. So let's see how this does. Oh, that is also not great. We get our nice return, which we were aiming for, as we were told, but it is incredibly volatile, especially during things like COVID and tariffs. So, maybe this is also not perfect. But, we're not done here. We can optimize more and more. So let's add another dimension where I'm going to cap the maximum volatility that we can see in a given period. And my graph is getting a little bit harder to read, but, it's okay. We're not in trouble yet. And let me just choose a value from this area, again, not too greedy, and all pretty reasonable values. We should get a good return now, right? And we fixed a couple things. Like we have better volatility, decent returns, but that drawdown is incredibly ugly, and no investor wants to invest in that. So I guess what do we do now? We can minimize the drawdown, optimize for the Sharpe ratio. Maybe we think our sector exposure is the problem here. But the problem is we now have dozens of factors that we can add to this, all to different degrees, and this becomes a very complicated problem. And I guess what's the kicker after all of this? That if we reduce our volatility, we get worse returns? We knew that already. And that's not to say that all of our back tests were bad and all of our optimization was bad. We have plenty of great back tests from this process. But the point of this project is not to create one great back test using a systematic set of rules. It's to create a set of back tests that are all great and raise kind of the bottom line for an investor. So that being said, one of the simplest ways we have right now that guarantees some better, more consistent returns is just simple linear combinations of the momentum and reversal portfolios that we had before.
Thank you, Casey. So he's exactly right. There is a lot we can do with optimization, but as we mentioned, there's always that risk-return trade-off, and whenever we're changing factors, that is the trade-off that we're accepting. So back to our friendly 50-50, our long-short portfolio. It's got a 2.1 Sharpe, but it's got a 45% max drawdown. 13.65 average yearly return, not too bad. and a 3.17 Sortino. Basically, our Sortino is saying that for every 1 unit of negative variance, we can expect 3.1 units of positive return, which is not too bad, but again, with a 45% max drawdown, it gets a bit tough. We could change these things, but if we change them, we're changing our risk return balance. But why would you take a risk like this? Why would you expose yourself to a 45% max drawdown? Well, maybe because if you buy this strategy, you're not holding it for a decade. You're only holding it when you think that times are going to be bad. And if you think that the market could be expecting an upcoming correction, this is a strategy that you might want to use. If you'd like to start an argument with someone in this room, ask them if the market is due for a correction. And while you're arguing about accounting fraud, about circular financing, $1 trillion in stock buybacks, PE ratios past 1,500, record market cap concentrations, record auto delinquencies, $1 trillion in margin debt, and record GDP versus US stock market valuations. While you're arguing about all of that, ask yourself, are you willing to place the bet that the near future is as profitable as the recent past? If you are, you're betting on OpenAI paying all 1.4 trillion of its infrastructure commitments. But if you're not, we do have the strategy for you. And you can adjust your risk and return however you want to get the exact exposure you want to an upcoming market correction. But if you think everything's fine, and if you think this graph is going to stay green for another year, and if you think OpenAI's valuation is fair, then I have 8 words for you. And I think you know what they are. I'm Kobe Walmsley. Thank you. So any questions?
What was the short funding assumption you guys made somewhere?
The short funding assumption?
Yeah, like in
Oh, yes. 4% margin debt on, or margin interest on, actually, I don't need to scroll all the way back.
Okay, and I guess the bigger question is if the idea is like you're sort of just putting this on when you think something's bad has happened, wouldn't the real question be this sort of strategy versus just buying puts or something like that?
Yeah, it's a tail risk hedging strategy is what we would be using. I'm sure you could buy puts as sort of an equivalent. It might be interchangeable. We haven't compared it.